All right, good morning and happy Monday to you. Back again for a Monday market update. I'm Matt Gouget, Matt the Mortgage Guy. I've got Nash Paradise, the Loan Wizard. We got some fun recap from last week. Jackson Hole, some words from Powell, a little bit of a change of direction from Powell's speech. We'll talk about that. We'll talk about some interesting observations Nash has about the correlation between the 30-year, the 10-year Treasury, what that means for mortgage rates now and moving forward. So I'm excited to jump into it, buddy. How you doing?
Yeah, man, I'm doing good. Appreciate the intro. And you're right. We've got some easy, simple things to talk about, but they're really big market movers. So we need to figure out, what does that mean for us? What does it mean going forward? And if you are a mortgage professional, how do I package this and get this to my referral partners, to buyers in the market? What information is relevant? Because the amount of misinformation is going to keep stepping up as we go forward. So let's talk about what happened last week. Looking at last week's economic calendar, there's not a lot of information. It was a very, very quiet week. As far as the numbers go, the S&P Global Services was in line. Everything was fine. It's fine. It's all fine. We got an interesting bit of feedback on the Open Markets Committee minutes on Wednesday, where I think it was, it wasn't Bostic or Waller. We got a Fed member speech that basically said, hey, as things come through, the tariffs aren't really into play yet, and they're going to make inflation higher. And we haven't seen that. And so like middle of the week last week wasn't super great for pricing. We saw a little bit of a drop from where we had been. Not great by the 21st. And then we get to Friday. Friday was the Jackson Hole Symposium. And what we expected was Powell to say a lot of nothing and to be very consistent like he has been for every time he talks, because that's Powell. And he kind of threw us for a loop here. And we got a nice overreaction to Powell's comments. So what he said, basically, is that the tariff inflation is transitory. It's going to align and impact employment, and basically that the way that we're going to receive the inflation expectations from the tariffs is going to be directly offset with changes to the labor market. So he signaled an indication of the likelihood of a September drop, which we know is highly likely at this point. But all that to say, investors were moved by Powell's newfound dovishness and, his basically reconciliation that the inflation numbers are probably not going to be that bad, which is interesting because this is the first time Powell has spoke since I think August 3rd, before we had the wicked adjustments from the Bureau of Labor Statistics. So the market was waiting to hear what he had to say. It overreacted on Friday. Things got a lot better. Mortgage rates hit, basically a year-to-date low. All that good news. So let's talk about what's going on this week. So we're already seeing the markets move a little bit away from Friday's overreaction, which is to be expected. I think we've balanced out, lost 7 basis points in the ticker here. Not a whole lot, but everyone is hanging out for Friday. Friday is going to be the day this week. Looking at my screen here, we're going to have core PCE. PCE is the personal consumer expenditures. This is the inflation data that the Fed likes. This is the one that mortgage people like. We like this inflation data because it is very useful, unlike some of the PPI, PCI numbers. So we're going to see the PCE core and headline coming out Friday morning at 7:30 a.m. I hate when numbers like this come out on Fridays because if it's good, we're going to see an underreaction. If it's bad, everything's going to overreact. We're going to see a big sell-off. Could be a pretty violent day. So all that to say, if you want to fast forward to the end here, I'm telling you, if you like it, lock it. I know that's really shocking. We don't normally say, oh, wait, no, we kind of say that all the time. But Friday is the risk day. That's the one not to play with. Where we are forecasting inflation to go up a little bit on the headline from 2.8% to 2.9%, but to stay consistent with rounding on the PCE month over month. Previous was 0.3%. Current estimations are 0.3%. So hopefully we hit 0.3%. Rounding can bite us a little bit there. Matt, your thoughts on last week and this week's news?
Yeah, I mean, I just thought it was interesting to, Jerome Powell, after so much, focus on inflation, kind of changed course and said, you know what, maybe we need a little bit of a change in stance on how we view this. And he brought up the, what is that called? It's like the average inflation. Like basically we're going to use a new metric when we're talking about a target. And I can't remember it off the top of my head. It was some like some acronym, some fancy acronym for like, here's how we're going to look at inflation. And so, maybe the jobs numbers spooked him a little bit. He's like, hey, listen, maybe, keeping the economy roaring and jobs is something that is important to me. And so for inflation, rather than have this, 2% target, let's use this. I wish I remember the name of that.
I know what you're referring to. I didn't think too hard on it when I heard it, so it's my bad there.
No, it's all good. But anyhow, like it was definitely a market mover. And to your point, it was a Friday, so markets gave us a little bit, 30 or 40 basis points, but they're never going to give us too much on a Friday. So anyhow, good news for people who are really rate sensitive. Although I've got some stuff to discuss at the end where it's a little bit of a fool's errand for some of the people that are in the market waiting for some magical moment in time where rates are lower in the future. But in the short term, good news for rates. And looking forward to some quarter point lower scenarios for people that I haven't talked to in a month or two.
100%. Well, let's move on here and talk about where we are looking at for the next meeting. So this has changed a lot since the last time I clicked on it. We've gone up and down on the likelihood of a drop on the September 17th meeting. Right now, we're sitting at 86.19%. It's back to being a foregone conclusion. Got a little dicey there middle last week. And by dicey, I mean like 78, 79%, but still moving in the wrong direction. And what we look at on this chart is trends. We want to know which way things are headed because that's going to tell us which way things are headed. So we are headed in a more positive direction, more likelihood of that drop. Second drop still not forecasted until December, but it is a highly likely drop then. So we're running out of meetings between now and the end of the year. In all likelihood, we're going to see these two drops. Cool. And because this is known, I was talking to actually my father-in-law last night about this. And then my wife was asking, okay, so how much are the rates dropping to? It's like, well, they'll go from 4.5% to 4.25 on the Fed funds. She's like, okay, well, what are mortgage rates going to do? Like, well, probably go up. And, that's just based on recent history. We know this is coming. We know it's going to happen. In all likelihood, this drop in the Fed funds rate is going to cause interest rates to increase. When did we see a big drop in the rates? Friday, when Powell was basically certain that we're seeing this Fed drop in September. So mortgage rates move on news, not in reaction to what has happened. And it is what it is, but we as professionals need to make sure that we're getting that information out into the marketplace, into referral partners, into buyers. Because if someone's waiting to see what happens after the Fed drops, to refinance their 7.25% interest rate, not feeling good about it. The last 3 drops would suggest that that's not going to happen. So, take this what it is. We know we got to drop in September, but what's going to happen between now and then? Well, a lot of data. This Friday is going to paint a picture and tell a story, which is good for us because we can come back Monday morning and talk about what happened. But let's let you talk about, Matt, here. Where are we with interest rates? What happened last week? What are things looking like?
Yeah, so we had a great day on Friday specifically, where rates got significantly better. They bounced around a little bit last week and I think popped up midweek. But by the end of the week, on this 30-year fixed rate average from Mortgage News Daily, we're right at about 6.5%. And if you look at that blue line and you go back, the whole year, your October of 24, since we've seen rates this low. Now, that can mean a ton of different things. To your point, people see that and they're like, well, rates will continue to go low, so I'll just wait and they'll continue to go lower. Not exactly how it works. And bless everybody out there who's using future Fed meetings as a marketing tool to say, the Fed's lowering rates. Like, I could say it till I'm blue in my face, how the overnight Fed funds rate is not the 30-year fixed rate mortgage. Not only that, but we've known for a long time that a September rate cut is highly likely. So when they do cut, no one's going to be surprised. It's not going to be a market mover. That specific date will not have a lowering impact to 30-year fixed rate mortgages. What we expect has already been baked in. And so it's been interesting on both the refinance side and the buy side. People are waiting for a future moment when the door of opportunity opens, and that's a refinance where you can save $400 a month, thing pays for itself within 18 months. You should probably walk through that door. I've seen way too many people pass, that door gets shut, and they keep knocking. But when they knock, I say, hey, listen, what we had at 6.5 for no cost that made a lot of sense. Now you'd have to pay a point for that, or 1.5. Now that, no cost refinance is 6.75%, or whatever the case may be. People get, time and time and time again. And I've said it and I've made videos and I've tried to help people, rates don't move flat and they don't move only in one direction. They go up and down and up and down, and you're going to get opportunity in refinance. You should probably take it. If you don't, you might be waiting who knows how long, another year. You might pay $400 a month extra to a servicer that probably doesn't need that extra money from you for another year. So that's another $4,800 out of your pocket. And for everybody who's in the purchase market, literally had a real estate agent that said, hey, I want to connect. I've been talking to our clients, Adrian and Susan, and they think that if they wait, things will get better. And sometimes you got to get those people on the phone and say, why? What is going to get better? Why do you think that? And, it's interesting dynamic, I guess, just dealing with human beings. What you seeing, buddy?
So I've got bad news disguised as good news. This is going to be confusing. I guess the good news or bad news is based on your perspective. So, on that chart that we just had up, we're looking at when's the last time rates were this low. Cool. Here's an interesting metric or data for you. So I'm looking at the 10-year treasury yields right now. And September 12th, 2024, it's the last time we saw rates at this 6.5% mark. You want to guess at where the 10-year treasury bond was then?
So we're at like 428-ish today, right?
Yeah, let me check my watch. Yeah, 4281. I'm definitely that guy that keeps the 10-year yield on my watch in real time all the time. I'm like, yeah.
You would be, buddy. So
good to see in real time.
So if the 10 years at 428 and we're at 6.5, it would stand to reason that we're in this same vicinity. I know that's not the answer, but I'm playing, I'm playing your game here.
It would stand to think that we were reasonably close. We were at 3.66.
Wow.
Yeah,
that's
3.66 is not real close to the 4.26 we're in right now. And let me tell you why this is bad news. So the 10-year treasury yield, so I'm looking at a one-year chart here, and we'll throw this in for the Monday market update next week to talk a little bit more about this. the wild swings in the 10-year Treasury have become really, really narrow in the last 6-8 months or so. And especially year to date, they've just been narrowing. We can't bust through the floor on the 10-year Treasury yields, and those have always been a primary driver of mortgage interest rates. So in September of last year, when we're working, a 6.5% overnight average rate and 3.66 on the 10-year Treasury yield, that's what 2.9% spread between them. That spread's not great. You don't want a nearly 3% spread between the 10-year bond and 30-year fixed rates. But that spread has narrowed significantly. So rates have been getting better and the 10-year yield has been staying high. So right now from, the 4.26 to the 6.52 overnight average interest rate, we're down to like a 2.25. That is in line with the best yield spread that we've seen in years now. It used to fall a lot, closer under 2% 10 years ago, but it's been a while. And the reason that's bad news is there's a lot of room to increase that yield spread. If we get some, flexibility in the market and little wild news coming here and there, we're going to start seeing that spread increase. We're going to start seeing mortgage-backed securities tighten up a little bit. So it concerns me that with all the improvement that we've had, it has not necessarily been driven by 10-year Treasury yields. A lot of it, over 0.5%, has been driven by the reduction and the narrowing of the margin between the 10-year yield and 30-year fixed average pricing. So yeah, last time we had 10-year yields at this area, like earlier this year, we were over 7% when we were still working those same margins. So the 6.5, 6.52 that we have right now isn't necessarily supported. Now, to be fair, the 10-year yield doesn't always have like a one-to-one impact on mortgage-backed security pricing, but those spreads have stayed really tight and pretty consistent for a long enough time that we can use that as a metric to watch. So all that to say, I'm a little concerned that those spreads have narrowed and we really need these 10-year Treasury auctions to go well. We really need some more money pumping in the bond market. I'm not sure how we can break back through that floor. We did cross under that 4% mark on the yields earlier this year, but for like a day. And then it popped right back up to 4.5. So would love to see some more movement on that to get excited about what's going on coming forward.
That's super interesting. And like, as somebody who's a casual observer of some of this economic stuff, I don't dive deep into it, admittedly, but I pay attention to it because I should as a mortgage broker. It's interesting because everything I've ever read or heard from smart economists is like that spread between the 10-year Treasury and 30-year fixed rate mortgage. Again, like you said, like it's a pretty good indicator. Like those have followed closely for a long time. Like there's probably not a better indicator for the 30-year mortgage than the 10-year Treasury. But my question to you, Nash, is I've always heard the spread was larger because of increased volatility. And economic nerds use the term vol because that's the cool way to say it. Like increased vol, uncertainty, the spread is bigger. Is there some indicator out there that like volatility has come down? There's more certainty in the market. And is that the reason why the spread has lessened, or is there something else in play? I genuinely don't know. And so I'm asking.
Yeah, it depends on who you ask. You got to think September last year, fourth quarter last year, we were right in the middle of a big old election. And that's probably going to be the highest volatility you're ever going to see. And no one knew for sure what direction the election was going. I mean, you had one poll going one way, another one going another way. Not until the end of the year did we know what was actually going to happen. And then you didn't know what was going to happen with a new president coming in and their economic policies. So I could definitely argue that we had the highest possible volatility between fourth quarter last year and even through first and second quarter this year when the tariff stuff was announced. Like, there's a lot of volatility. Are we better than that now? I think that logistically speaking, anyone can make an argument that we have a better understanding of what's going to happen going forward, especially as it relates to, total national economic news. But yeah, it's still a little volatile. I mean, we got lots of movement in the different auctions, the ending of the quantitative easing program, followed by, I forget what the opposite of quantitative easing is, the sell-off. Like there's a lot of, and now you get the privatization of Fannie and Freddie. You've got the president wanting to try to lower interest rates, so we reduce our debt payments. Like, I still think it's pretty volatile, and I don't know that the 2.25% margin yield that we have right now is a safe thing to bet on going forward. So, to summarize all that, we have no control over any of it. It's interesting and it's relevant because it just leaves a lot more opportunity for things to get worse and not necessarily better.
Right. Yeah. It's like impossible that rates go to 6 with a 10-year above 4. But it's perfectly plausible that they go to 7 because we've seen that 290 basis point spread. So yeah, I think you're right. It probably just further solidifies some advice that I've been given. I know that you've been given is, these rate opportunities when the door opens, like, you don't take it for granted. You don't, expect there to be lower rates in the future just because we're lower today than we were a month ago. So that's my parting advice.
Yeah. Couldn't have said it better myself. Take what we've got, run with it, make the best decisions you can. Make sure you're sharing this information with other people who otherwise wouldn't know. And then check in next week. We'll talk about how those PCE numbers came in and how they're going to impact things going forward. And we'll dive a little deeper into bonds and bond yields and have some slides for that.
Sounds good. Thanks, buddy. Have a good week.
Yeah, man. Take care.
Bye-bye.